Welcome to another Disruptive Discourse video. As you all know, every weekday Ark Invest releases a list of stocks purchased and sold for their ETFs that day. The aim of this channel is to analyze each and every one of those stocks on a weekly basis. So for this video, I'll be analyzing the 11 new stocks purchased between October 26 and October 30. For each stock, I'll look at who they are and what they do, what growth potential they have, and my personal view on the stock. But as is customary on this channel, let's start with the repeat purchases which I have already analyzed in earlier videos. They purchased additional shares in these stocks that I analyzed in the first episode of these series. Agora, 15.3 million, Fastly, 11.5 million, and Intercontinental Exchange, 24.2 million. As for the second episode of this series, I analyzed a stock called Repair Therapeutics, and they purchased $4.1 million worth of additional shares in that company. If you'd like to see my analysis on those stocks, then feel free to check out those videos. The link will be in the description box. Also, if you would like to get the trade notifications from Ark Invest, then watch episode 1 where I share details about that. Now on to the new stock purchases. The first is Baidu. In this week, Ark purchased $1.9 million worth of Baidu. Baidu can be described as the Google of China. Just as you have the FANG stocks which dominate the tech industry for the rest of the world, China has the BAT. No, not that type of BAT. It stands for Baidu, Alibaba and Tencent. Baidu practically has the monopoly over internet searches to date, with 70% of China's internet searches taking place on its platform, especially as Google is not available in China. In fact, none of the FANG stocks operate in China. Baidu has been around since 2000, so it's as old as Google. It also owns the main video streaming platform in China called iQIYI, which is the Netflix of China. According to Wikipedia, Baidu is the 5th most visited site in the world as of October 2020. Most of its revenue is from pay-per-click advertising, similar to how Google and Facebook generate their revenues. It's slowly lost ground amongst the BAT FANG stocks in terms of revenue generated. In 2017, it was second to last, being ahead of Netflix, and in 2019, it was a distant last. It has also had its fair share of controversies, such as manipulating its search results by selling first page appearances irrespective of relevance, but that has now been resolved. In terms of its future growth potential, it has begun to diversify into other areas such as autonomous driving technology with the launch of its Apollo project, which could potentially be a huge future growth driver for the company. It uses a similar approach to autonomous driving like Alphabet's Waymo, which uses LiDAR as the main guiding system, which in my view is not quite as good as the approach being taken by Tesla or Mobileye, which rely entirely on camera. Its compound annual growth rate is 15% per annum. If it continues to grow at this rate, it will take 5 years to double its revenue, which isn't too bad for a large cap company, I guess. Whilst it's a stock that I would happily consider adding to my portfolio for sure, I wouldn't necessarily classify this as a growth stock in the strictest sense of the word. The next stock is Virgin Galactic, and Ark Invest purchased $1.1 million worth of the stock in this week. This company is owned by Sir Richard Branson, and his plan is to commercialize lower Earth orbit flights for the rich. I must admit this is an excellent business model, and there will be no shortage of billionaires queuing up to get into space. Here's a short clip from CNBC which gives a pretty good visual of what you could expect to experience if you're considering buying a ticket. By the way, a ticket for one of these half-day experiences is $250,000.
tourism is generally broken down into two main categories, suborbital and orbital.
With a suborbital flight, we're not actually completing a full orbit of the Earth. So the suborbital rocket will go up to the edge of space. So we are assuming this is going to be around 100 kilometers and then come right back down.
At the forefront of making orbital space tourism a reality is Virgin Galactic.
Virgin Galactic's experience would entail customers coming, doing about 3 days of training, and then strapping in to the spacecraft, which is joined to a carrier jet aircraft that would lift it up to about 50,000 feet altitude, drop it, the rocket motor of the spacecraft would fire, carry people up to the edge of space to kind of do this slow backflip in microgravity. It's where you get a few minutes of weightlessness and kind of get to see the experience of space. And then without power, because at that point the rocket motor is already fired and is spent, it would glide back down through the atmosphere to land on a runway.
As for the growth potential, the opportunity is great. There aren't many other companies queuing up to enter the space tourism business for lower Earth orbit. Jeff Bezos' Blue Origin is another one planning to do something similar, but tourism is not its main object. Elon Musk's SpaceX is another, but again, its mission is to go to Mars and populate it, thereby making us a multi-planetary species. So it looks like Virgin has the niche all to itself for now. If you're thinking of taking a position in this company, then in my view, there's no better time than now to do so, as the stock has recently taken a dive due to the general market volatility, which has little to do with the company. In my view, there is a lot of upside here, and I can see why Ark Invest has taken up positions in the company, albeit a relatively small position for Ark Invest standards. The third stock is Opendoor. Ark Invest purchased $7.7 million worth of his stock in the week. Opendoor, also known as Social Capital HEDOSOPHIA Holdings Corp. No. 2, is a special purpose acquisition company, otherwise known as a SPAC. The SPAC was the empty shell owned by billionaire rockstar investor Chamath Palihapitiya, who is famous for being one of the very first investors in Facebook. So back to Opendoor, aka IPOB, aka Social Capital HEDOSOPHIA Holdings Corp. No. 2. Yes, I know, it's a mouthful. Its business model is such that it's set to disrupt the traditional home buying agents in the US. No longer would you have to go to a traditional agent to buy a home. You can buy direct from Opendoor and sell direct to them, cutting out the waiting time for buying and selling your home. In theory, this is an excellent model because it reduces the waiting time compared to the traditional buying and selling process, but there are drawbacks. A quick search on YouTube reveals a few complaints about people's personal experiences of latent damages to properties, which were only discovered post-purchase. But in all fairness, you will never please everyone. The most complaints, though, are from home sales agents themselves, which you'd expect because companies like Opendoor are taking away their businesses. What is fascinating is that there are three major players in this space: Opendoor, Zillow, and OfferPad. Zillow is already a publicly traded company with a market cap of over $20 billion, whereas Opendoor's market cap is significantly lower at $0.8 billion. But when you look at their respective revenues, and I'll stand corrected, Opendoor's revenue is just under $2 billion for the last 6 months, ended June 2020, whereas Zillow's is $2.7 billion for all of 2019. Now, this would suggest that Zillow is currently trading at 20 times more than Opendoor's share price, whereas based on the respective revenues, Opendoor arguably should be worth more than Zillow. Those are just my thoughts on the company. If you're thinking of buying the stock, I would consider this a good time than ever to do so. There's a huge growth potential here, not least because it would appear to be undervalued in comparison to its main competitor. I may take a position in this company in the future. Next stock is Twilio. Ark Invest purchased $56.9 million worth of Twilio in this week. If I had to describe this company in a few words, I would call it the chatbot of Silicon Valley, because most companies rely on Twilio to help deliver cloud-based communication solutions between companies and their clients. So, for example, Netflix uses Twilio. Every message you receive from Netflix about a new series being released or that your subscription has been renewed were all delivered by Twilio's chatbots. There's a really interesting interview with the CEO of Twilio following their recent acquisition of a company called Segment. Take a quick listen to this.
Twilio is the leading cloud communications platform. We allow companies to communicate with their customers across a wide variety of channels, whether it's voice phone calls, text messages, video, chat, email, and more. We're the leading platform that does this. We'll power close to 1 trillion customer communications this year. But building a customer relationship requires two things. First, it's understanding your customer, and then it's acting on that understanding. Understanding your customer is about customer data, all the bits of information about your customer that reside in the myriad systems that every company has, assembling that into a complete picture of your customer, and then you can act on it. And acting on it is communications. That's what Twilio does. The first part, understanding your customer, that's what Segment does. And so by bringing them together into one platform, we can now help companies assemble that complete picture of their customer and then act on it in order to build great customer relationships.
Yeah, we've been huge believers in Twilio from day one. I mean, we've always looked up to Twilio, all the ways that they design APIs, the way that they sell to developers, the way that they built the company. So we've been huge fans of Twilio for many, many years. And I think the whole space of building and selling to developers, building these building blocks that developers can build on top of, is just very, very early in that space. So we're not taking a short-term perspective on this. This is a long-term bet on the future of how software is built and how all these APIs come together and what the future of customer engagement and digital world looks like. All of that is accelerating. So when we look towards the long term, I think it's a super awesome and reasonable bet.
This is another stock with a lot of runway as we move ever closer to a fully digital world. There's definitely a bright future for the company, but it has already seen a massive run up in its value with an over 900% increase in valuation. But there's been a healthy pullback in recent times, which I suspect is the reason why Ark Invest have bought some more shares recently. That is, if you can describe $56 million worth of shares as some. Nevertheless, it's a stock that I have invested in, but I would like to build up my position if I see a bit more pullback in the stock price. The next stock is Exact Sciences. Ark Invest has invested a whopping $128.5 million this week in this stock. This is a company that Cathie Wood is clearly bullish on. And as I said, in the week of October 26 to October 30, they've purchased over 103,000 shares, and each was trading for $124 during that week on average, making it a total investment of around $128 million. That was their single biggest investment in one stock that week. So let's see exactly why that's the case. Exact Science is a company that specializes in early detection for colon cancer, which is the very same cancer that sadly took the life of Chadwick Boseman. They have developed this product and it has FDA approval already, and it has Medicare licensing also. What they've also recently done is to use their expertise to set up testing for COVID-19, and they've been doing the testing successfully, therefore creating a new line of revenue for the company during this pandemic. It is safe to say that this company has a lot of upside to it. What is also striking is that Ark Invest have been selling Illumina. You may recall from my previous video that I did on Pacific Biosciences and Illumina, and although Illumina acquired Grail, which is also an early cancer detection company, still at the preclinical stage of its early cancer detection program, clearly Ark Invest sees more value in Exact Sciences than in Illumina's Grail. Exact Sciences early cancer detection will most likely be rolled out to the rest of the world and will generate significant revenue for the company. So there's a real growth driver here. It therefore makes sense that Ark Invest are being very bullish on the company. The success of Exact Sciences is also reflected in its revenue, which has grown from $99.38 million to $876.29 million in the space of 3 years, which represents a 106% compound annual growth rate per annum, thereby doubling its revenue in only 11 months, which in my view is phenomenal. I would certainly be looking to add this to my portfolio. The next stock is Shopify, and Ark Invest added $17.1 million worth of this stock in that week. Shopify is an online marketing and sales platform where anyone from small entrepreneurs to large businesses can sell their products to anyone. It is perhaps one of, if not the largest online-only retail companies, second only to Amazon. And like Amazon, it has been experiencing explosive growth. Its revenue grew from $389 million to $1.58 billion in the space of 3 years, giving it a compound annual growth rate of over 59%. Its monthly recurring revenue, i.e. those paying monthly to use their services, has been steadily rising, and that will only get better in the current climate. So no question about the current and future growth prospects for Shopify. Shopify's current stock price has been on an exponential rise this year, and buying into the stock at this price would be too steep for me. But I wondered whether there was any particular catalyst as to why Ark Invest purchased on the 27th of October. The only news I could find is that Shopify merchants will be able to advertise their merchandise on TikTok, including those without a strong TikTok following on their own yet. The real benefit to this is that they would be able to connect with new audiences using content that feels authentic and genuine to the TikTok experience. And of course, you would expect that this will drive sales and traffic to Shopify from TikTok, which is part of this new e-commerce trend that is set to be the next great driver of growth for companies. It is very tempting to get into the stock, but for me, I think I'll keep my powders dry for the time being and see how things go. The next stock is Accolade. Ark Invest purchased $1.8 million worth of this share in the week. Accolade is a healthcare company which focuses on becoming the one-stop shop for their members' healthcare needs. They collect all of their clients' healthcare data and use that information to make smart decisions about their healthcare plan so that people can get the right treatment at the right time. Here's an interview with the CEO that gives a very useful insight into the company and its customer base.
Well, first of all, thank you for having me. I'm thrilled to be here and on such an important day for Accolade and all of our employees. Secondly, one, you're absolutely right. Comcast has been a customer, and we're thrilled that we're actually delivering service to you, and hopefully you're really happy with the service. We've been delivering that service to Comcast for, call it, almost 10 years now through multiple reiterations of that agreement. And the beautiful part of that story is we're delivering incredible value. We're lowering costs. We're improving healthcare outcomes for all of the Comcast employees, and in turn making them a lot happier in terms of experiencing the healthcare ecosystem. Directly to answer your question, Comcast as a percentage of revenues continues to decline. We're growing. Last year, we more than doubled our customer base. We're really bullish on our future as it relates to continuing to grow and seeing that number decline, while Comcast will always remain a super important customer to us. In fact, we're seeing increased demand for our service, so much so that just last month we released a brand new service called Accolade COVID Response Care. That offering actually helps employers get back to work. We brought on our first Fortune 1000 client just last month. We released the product last month and brought on our first client this month and are live with that client this month. That offering is about testing, it's about education, it's about contact tracing, and it's about employee certification. But beyond that, all of our core solutions are about simplifying healthcare. At the end of the day, healthcare in this country is siloed, it's opaque, And too often people are making decisions about their care, not knowing what the repercussions of that decision are, both on their own health as well as on their finances. And so that particular need is even more profound today, and therefore buoying our demand environment.
The company IPO'd in July this year, but has been around for well over 10 years. Telehealth companies are benefiting from the recent lockdowns, and they're only set to get bigger, and I can certainly see why Ark Invest will be interested in this company. In the last 2 years, it has grown its revenue by over 31% year over year and could experience even bigger growth in the future. This is another stock to keep an eye on, but for me, I wouldn't be taking a position in the stock just yet. The next stock is Teladoc, and during this week, Ark Invest purchased $96.8 million worth of shares in the stock. Teladoc has just recently merged with Livongo to form, in my view, the largest telehealth company in this space. Both companies complement each other in terms of the services that they provide. Teladoc offers remote connections to physicians, whereas Livongo clients have access to tools that help monitor their health and then recommend ways to improve their health through lifestyle changes. So by combining these two, there's a whole host of cross-pollination going on between the respective businesses. So this merger really creates an instant boost for both companies. Also, because they can offer a far more comprehensive one-stop telehealth service, more and more companies are likely to turn to their services, so you can really expect an explosion in the company's growth. In the last 3 years, it has seen a 65% growth year over year, and I suspect that this will be even accelerated with the merger. It's a company that I'm bullish on, and one which Cathie Wood is also very bullish on. It is no surprise that it is the second largest purchase of that week by Ark Invest at $96 million. The next stock is Personalis. Ark Invest purchased $0.9 million worth of this share in that week. Personalis is a biotech company that is developing the next platform for providing the most comprehensive view of cancer possible, whereas other technology platforms have narrowed their focus to 50 to 500 genes and in turn narrowed their time to market. Personalis has taken a more ambitious approach by attempting to track changes in all 20,000 human genes with a single test. The company is at a very early stage, so there's a lot of opportunity to build a real head of steam as it improves its platform with more data. Its revenue is also growing moderately, and as the platform gains more adoption, this should have a positive impact on its revenue and share price. Not a bad stock at all to add for future growth. The next stock is Spotify, and in that week, Ark Invest purchased $70.6 million worth of this stock. Spotify is a behemoth in the music streaming industry. It has the largest paid music subscriber base with 130 million as of March 2020. Its closest rival being Apple Music with 60 million subscribers. Spotify IPO'd in April 2018, which is 2 years ago approximately, and its share price has doubled since then. Its revenue has also grown considerably, but has it reached saturation point, or is there more room to grow? Well, it recently added Joe Rogan to its list of celebrity podcasters with the aim of stealing more market share from YouTube. It remains to be seen whether there is much more room for growth. I'm not so optimistic personally, but it's a great company without any question. I'm curious though as to why this was Ark Invest's third largest purchase of that week. If anyone has any theories, then I'm keen to hear it. But for now, I do not own any shares of Spotify, and I have no intention of adding it to my portfolio for the time being. The last stock is KE Holdings Inc. Ark Invest purchased $14.4 million worth of this company in that week. KE Holdings could be best described as the Chinese version of Zillow or Opendoor. It covers everything from home sales, both online and offline. It also provides financial solutions and renovations, so it literally is a one-stop shop for home ownership. It has had 39 million monthly active users on its mobile platform, 600,000 sales in its existing homes category, and 500,000 sales in its new homes category. It's been doing really well in China, and that's borne out in its current growth rate. It is the standard bearer for digitizing home sales in China, so I expect there to be more growth with this company going forward, and no surprises that Cathie Wood is investing in it. Now, to sum up, if you take a look at all 11 stocks mentioned in this video, there are 4 standout stocks for me, excluding the top picks from my previous videos such as Agora and Fastly. The top 4 with the greatest potential for exponential growth would be Exact Sciences, Teladoc, Twilio and Opendoor. And that is reflected in the fact that these stocks have been heavily added to the Ark Invest ETF over the past few weeks. As usual, if you've enjoyed this video, like, comment and subscribe. I want to give a big shout out to all of my new subscribers. I really appreciate you joining the channel, and that is what really motivates me to continue making these videos, which take a lot of time to put together. Thank you all once again, and I'll see you in the next video.